The American auto world is on fire. And no, not from high sales or booming demand. Jeep and Ram just dropped a bombshell that's sending shockwaves across the entire U.S. auto industry. In a move that nobody saw coming, they're slashing prices by up to 50%. That's not a typo. 50%. Half off. Trucks and SUVs that were once unaffordable for the average American are suddenly within reach, and dealerships are scrambling to adjust to the chaos. This isn't a seasonal sale. This is a desperate pivot, and it's exposing how deep the problems really go at Stellantis, the parent company of Jeep and Ram. So why the sudden fire sale? Stellantis has been caught in the perfect storm. Overproduction, bloated inventories, weakening consumer demand, rising interest rates, and a wave of EV miscalculations have all converged. The company is sitting on tens of thousands of unsold vehicles, clogging dealership lots across the country. And while Ford and GM are cautiously trimming prices, Jeep and Ram just detonated the discount bomb. The sticker shock that once kept shoppers away is now being replaced by jaw-dropping offers. Ram 1500s that were going for $60,000 are now being sold for $30,000 or even less. Jeep Grand Cherokees have had their prices cut so deeply, it's making longtime buyers wonder if they overpaid just months ago. But make no mistake, this isn't a generous move. It's a warning sign. Stellantis isn't doing this out of kindness. They're doing it to survive. Just weeks ago, Bank of America downgraded Stellantis stock and slashed its price target from €16 to €10, citing weakening fundamentals and a deteriorating U.S. outlook. Behind the scenes, dealerships have been begging for relief, unable to move high-price models. Ram's full-size trucks have been collecting dust, while competitors like Toyota and Ford slowly adjust to market conditions. But now, the floodgates are open. Massive rebates, 0% financing, employee pricing for everyone. It's all back and bigger than ever. And it gets even wilder. Stellantis is offering these deals across multiple trims, not just base models. That means fully loaded trucks with all the bells and whistles. Leather seats, panoramic roofs, high-end audio are being handed over for prices we haven't seen in over a decade. For consumers, it's a golden opportunity. For competitors, it's a nightmare. Ford and GM now face enormous pressure to respond. They've held firm on pricing for months, but that strategy might collapse under the weight of Stellantis' aggressive move. Industry insiders are calling this a race to the bottom, because once one automaker slashes prices this drastically, the rest often follow, whether they want to or not. And in a time when interest rates are still punishing and household budgets are stretched thin, the only way to lure buyers is through pricing warfare. Jeep and Ram just fired the first shot. And there's another layer to this EV strategy collapse. Stellantis had big plans for electrifying Jeep and Ram, but the rollout has been a disaster. The electric Ram 1500 REV has been delayed and overshadowed by Ford's F-150 Lightning. The plug-in hybrid Jeeps haven't moved the needle. Consumer interest in EVs has stalled. So now, Stellantis is shifting back to gas-powered models and cutting their prices dramatically just to clear space for what's next. It's a stunning reversal, and it shows how quickly the EV dream can become a nightmare for legacy automakers caught off guard. Meanwhile, used car values are dropping fast. Wholesale auctions are flooded with trade-ins, and dealers are lowballing offers like never before. Anyone buying a new Jeep or Ram at full price even 3 months ago is likely looking at an immediate loss in value. Resale prices are crashing. That's how steep the discounting has become. And for the first time in years, American car buyers are getting the upper hand, if they know where to look and how fast to act. But this isn't just about short-term deals. The implications go much deeper. This kind of pricing panic suggests major financial distress inside Stellantis' U.S. operations. You don't slash half the value of your most profitable vehicles unless your back is against the wall. And with Stellantis heavily reliant on Ram and Jeep for its North American revenue, this fire sale could either spark a revival or accelerate collapse. And there's more. Behind closed doors, several Stellantis dealers are raising red flags. Not about the discounts, but about the long-term consequences. Many of them invested heavily in inventory last year, expecting steady sales and solid margins. Now, they're sitting on vehicles that have instantly depreciated by tens of thousands of dollars overnight. Their profitability has been wiped out, and for some, this price war could spell financial disaster. Dealerships in rural areas that rely heavily on Ram trucks and Jeep SUVs are especially vulnerable. They simply can't absorb these kinds of losses. Adding fuel to the fire, Stellantis has reportedly cut dealer incentives and support programs, forcing them to take the full hit on these price drops. That means it's not just a race to sell inventory. It's a survival battle for hundreds of family-run dealerships across the country. Some are being forced to take losses just to make room for new shipments they didn't even ask for. It's a logistical nightmare that's now spiraling into a national-scale correction for Jeep and Ram. Meanwhile, consumers are flooding showrooms, but not always to buy. Many are coming in to renegotiate existing deals or demand price matching on recent purchases. Social media is exploding with complaints from recent buyers who feel cheated after seeing brand new prices drop by $20,000 or more within weeks. Class action lawsuits aren't off the table if this keeps escalating. And that adds a whole new layer of risk for Stellantis, which is already facing regulatory heat over quality issues and past recalls. And the timing couldn't be worse. Just as Stellantis is slashing prices, the National Highway Traffic Safety Administration, NHTSA, has opened an investigation into Ram trucks over potential brake and shift interlock defect that could cause rollaway incidents. With nearly 1.2 million vehicles under review, including some of Ram's bestsellers, the PR damage couldn't be more devastating. Safety concerns combined with slash prices create a perception that Stellantis products are both risky and depreciating rapidly. Not a great look for a brand that once symbolized rugged reliability. At the same time, Jeep is facing its own identity crisis. The once legendary off-road brand has diluted itself with an overcrowded lineup, confusing trims, and questionable pricing strategies. The Compass and Cherokee have been underperforming. Even the Wrangler, the crown jewel of Jeep, is facing stiff competition from the new Ford Bronco, and now needs heavy discounts just to stay relevant. The Grand Wagoneer, once touted as a luxury SUV competitor to Range Rover, it's now being offered with $10,000 plus cashback just to move units. It's a brand unraveling under its own weight, and these price cuts are only masking the deeper problems temporarily. And while some consumers are celebrating these insane deals, others are watching carefully, wondering what happens next. Will these prices become the new normal? Or is this just the beginning of something much darker? A sign that Jeep and Ram may not survive this economic crossfire intact? There's also the macroeconomic ripple to consider. Automakers rarely act in isolation. Ford, GM, Toyota, even Tesla, they're all watching. If Stellantis succeeds in clearing inventory with these deep discounts, others may have no choice but to match. We could be standing at the edge of an all-out pricing war in the auto industry, one that resets the entire landscape overnight. And the stakes? They've never been higher. And while the headlines scream about 50% off, what's not being talked about is how this will impact trade-in values, lease residuals, and financing risk across the board. Banks are starting to worry. Auto loan defaults are rising. Consumers who bought vehicles in 2022 or early 2023 at inflated prices are suddenly underwater. And if their credit is shaky, lenders could face a tidal wave of repossessions. In fact, analysts are already warning of a potential used car market crash if this trend continues into the fall. And we haven't even touched on the global implications yet. Stellantis isn't just a US player. It's a multinational giant with deep stakes in Europe, South America, and beyond. But the American market has always been its profit engine, powered by high-margin pickups like the Ram, 1500 full-size SUVs like the Grand Cherokee and Wagoneer. If Stellantis loses its grip here, the entire corporate structure could start to wobble. Investors in Paris and Milan are already reacting nervously, with stock volatility rising sharply since the discount news broke. There's real concern that this isn't just about moving metal. It's about keeping the entire empire afloat. European analysts are pointing to this U.S. fire sale as a red flag, a sign that Stellantis may be on the verge of a broader restructuring or even forced divestitures. The company has been aggressively cost-cutting, shuttering plants, and laying off workers. And while CEO Carlos Tavares has been touting electrification and digital transformation, these price cuts send a very different signal to the market. Panic, not planning. The strategic contradiction is glaring. On one hand, Stellantis is pushing high-tech EVs like the Ram REV and Jeep Recon with premium-level pricing. On the other, it's slashing prices on its bread-and-butter gas models like there's no tomorrow. That sends mixed signals to both consumers and investors. Are they a forward-thinking innovator or a legacy manufacturer bleeding out in a shrinking ICE market? And then there's the supply chain nightmare. Slashing prices so dramatically throws the entire parts and logistics network into chaos. Tier 1 and Tier 2 suppliers who operate on razor-thin margins now face pressure to cut their costs as well. That could lead to more plant shutdowns, workforce reductions, and delivery delays, particularly as demand becomes wildly unpredictable. No supplier wants to ramp up production for vehicles that might suddenly become unprofitable next month. At the same time, Stellantis is renegotiating contracts with labor unions. These deep price cuts could severely weaken their negotiating position. UAW leaders are already on edge after last year's bruising contract battles, and now they're seeing a company dump its most profitable products onto the market at bargain bin prices. That raises real concerns about job security at U.S. factories in Michigan, Ohio, and Illinois. And the political storm is brewing too. Lawmakers in auto-heavy states are sounding the alarm. Local economies built around Jeep and Ram manufacturing are bracing for impact. If these price cuts lead to extended production slowdowns or layoffs, the ripple effect will hit everything, from suppliers to service shops, from real estate to retail. What looked like a great deal for consumers might end up triggering a much deeper economic disruption in the industrial Midwest. Meanwhile, analysts at Cox Automotive and J.D. Power are adjusting their 2025 forecasts, warning that if Stellantis maintains this discount pace, vehicle depreciation curves across the industry will shift dramatically. This will affect not just resale values, but insurance premiums, lease calculations, and even fleet pricing. It's a domino effect, and the first tile has already fallen. Even automakers outside of Stellantis are feeling the tremors. Toyota, which has remained conservative in pricing strategy, is reportedly reevaluating its next round of incentives. Ford has quietly begun increasing dealer bonuses on select F-Series trims. GM, which has tried to avoid deep cuts after its own inventory bloat, now faces internal pressure to follow suit or risk losing share in the truck and SUV wars. The game has changed, and no one is safe. But perhaps the biggest question is still unanswered. How long can Stellantis sustain this strategy? Because slashing prices in the short term can help clear inventory. But if the discounts continue for months, the company risks setting a new baseline for its products. Consumers may never again be willing to pay full price for a Jeep or a Ram, no matter how good the marketing is. The brand equity, carefully built over decades, could evaporate in a matter of months. And what happens when those slash-price vehicles begin flooding the used market in a year or two? We could be heading into a situation where resale values drop so far that even leasing becomes unprofitable. Banks, fleet companies, and rental agencies are watching closely. If they lose confidence in future vehicle values, they'll pull back hard, and that could choke off the financing lifeline Stellantis desperately needs to stay afloat. And yet, we're only at the beginning of this story, because while Stellantis has made the first dramatic move, everyone in the industry knows this is a high-stakes gamble. If consumer demand doesn't surge immediately and stay strong, these fire sale prices could backfire catastrophically. Discounting like this can train buyers to wait, to hesitate, to expect the next price drop. It creates a toxic cycle of delay that poisons future sales. Why buy now when you believe it'll be even cheaper in 2 months? That's the exact kind of buyer psychology that nearly collapsed Detroit automakers in the 2008 financial crisis. And history may be repeating itself. Industry veterans are already comparing this move to the dark days before the Great Recession, when bloated inventories led to brutal markdowns, factory shutdowns, and government bailouts. While the economy today is different, the core issue remains the same. Too many expensive vehicles, and not enough buyers willing to pay for them. And don't forget, these price cuts are not limited to dusty 2023 models sitting in backlots. We're talking about brand new 2024 inventory, fresh from the factory, being sold at used car prices. In some regions, Ram 1500 Laramies with full tow packages and 4x4 setups are now listed at $28,000 to $32,000, down from MSRP prices pushing past $60,000. Grand Cherokees? Down nearly 40%. Even the Wagoneer, once seen as Jeep's luxury flagship SUV, is being slapped with $12,000 to $15,000 discounts, sometimes more with trade-ins or dealer cash. This isn't a sale. It's a signal flare from a sinking ship. And if you think these deals are confined to just rural dealerships with slow foot traffic, think again. Even metro area showrooms in Dallas, Phoenix, Chicago, and Atlanta are joining the discount parade. High-volume dealers are cutting prices before Stellantis mandates it, just to stay ahead of the fallout. The desperation is visible. Aggressive ads, pop-up sales, inflated trade-in offers, social media giveaways. Some dealers are even offering free gas cards or lifetime oil changes just to sweeten the deal. But here's what's really wild. Insiders claim this is just phase one. If the current pricing strategy doesn't yield quick results, Stellantis is prepared to go even further, possibly slashing prices on their incoming EV models before they even hit the streets. That includes the upcoming Ram 1500 REV and Jeep Recon, which were originally positioned to compete with Ford's Lightning and Tesla Cybertruck. If those models enter the market with deep discounts, it will destroy the perception that these are premium, future-facing vehicles. And once that brand damage is done, it's nearly impossible to reverse. At the same time, Wall Street is getting nervous. Auto sector investors are spooked. Stellantis bonds are under pressure. Analysts are downgrading supplier stocks tied to Jeep and Ram. Hedge funds are quietly reducing exposure to automotive equities, and some are even betting against a rebound, citing the long-term risks of structural devaluation. Meanwhile, foreign automakers are watching from the sidelines, and they smell blood. Hyundai, Kia, Honda, even VW are positioning themselves to scoop up frustrated Jeep and Ram buyers who may be looking for more price stability, better warranties, or stronger resale performance. If even a fraction of Stellantis' loyal customer base defects, it could trigger long-term brand erosion that pricing alone can't repair. And for consumers, this is one of the most unique moments in recent automotive history. You're witnessing a turning point where supply chain greed, market misreads, and executive overconfidence have collided to create an opening most people never imagined. But it won't last forever. And when the dust settles, the landscape of American trucks and SUVs may look completely unrecognizable. Because the deeper you dig into these discounts, the clearer it becomes. This isn't about moving inventory. This is about saving the company. And if this plan doesn't work, Stellantis may be forced to make choices that shake the U.S. auto industry to its core. We're talking about plant closures, mass layoffs, canceled product lines, and a radical rethinking of what brands even survive. Jeep and Ram, once the company's crown jewels, are now sitting on a cliff's edge. If this pricing war turns into a bloodbath and the financial hemorrhaging continues, Stellantis might begin offloading entire divisions just to stay solvent. Already, whispers are circulating in the investment world. Some analysts are speculating that Stellantis could spin off or even sell underperforming nameplates. Jeep, once a global icon, has lost market share in nearly every major region except the US, and now it's struggling even here. Ram, while still a player in the truck wars, can't match Ford or GM scale when margins are crushed. If revenue falls below a certain threshold, it's not unthinkable that Stellantis might look to license, merge, or divest these divisions to private equity firms or foreign automakers seeking entry into the American market. But Stellantis isn't just facing competition from legacy rivals anymore. The electric insurgents are coming, and fast. Rivian, Tesla, and now even BYD from China are circling, watching these price collapses like vultures over a wounded animal. The moment Stellantis shows signs of long-term instability, those EV startups will pounce, offering modern tech, sleek design, and most importantly, price consistency. That's something Jeep and Ram can't offer in a world where sticker prices swing wildly every few weeks. Even loyal Stellantis customers are beginning to lose confidence. The price slashing may attract deal hunters, sure, but for those who bought at the peak, it feels like a betrayal. Imagine paying $55,000 for a new Grand Cherokee in April, only to see the same vehicle listed for $31,000 in July. That kind of sudden devaluation doesn't just sting, it destroys trust. And trust is one thing money, and discounts can't buy back overnight. And what about leasing? It's a disaster zone, because when residual values fall off a cliff, lease payments shoot up. Lenders can't predict what these vehicles will be worth in 2 or 3 years, so they're adjusting terms, increasing down payments, and reducing mileage allowances. That means fewer lease deals for customers, lower volume for dealerships, and tighter margins for everyone involved. It's a ripple effect that reaches far beyond the showroom floor. At the government level, the alarm bells are starting to ring. Some lawmakers are now calling for oversight into how these pricing strategies are affecting American labor and consumer finance markets. There are growing concerns that the auto industry could spark broader economic instability, especially in regions where Jeep and Ram production is a major employer. With the 2024 elections looming, no administration wants to deal with another Detroit-style collapse or a sudden spike in auto loan delinquencies tied to artificially deflated vehicle values. And still, the questions pile up. What happens when these discounted vehicles start hitting the resale market? Will fleet companies pull out of future Ram contracts? Will Jeep be able to maintain its global brand presence? Or will it retreat into a low-margin, US-only identity? Will consumers buy again from a brand that just slashed the floor out from under them? And perhaps the most critical of all, is this just the beginning of a much larger unraveling within Stellantis? Because every indicator is flashing red: oversupply, underperformance, financial pressure, leadership panic. And while the discounts may seem like a win for the consumer, they may actually be a death rattle for a company too bloated to adapt and too leveraged to pivot. But here's what most people don't realize yet. This isn't just a Stellantis problem. It's a warning shot for the entire auto industry. Jeep and Ram are simply the first to flinch. But if these massive price cuts work, if they actually trigger sales and clear bloated inventories, you can expect other manufacturers to follow suit with equal aggression. And once that floodgate opens, the whole market could tumble into a spiral of collapsing MSRP values, shrinking profit margins, and eroding brand equity. The dominoes are already wobbling. GM has been quietly stacking incentives behind the scenes. Ford is ramping up cash offers on select trims of the F-150 and Expedition. Even Toyota, typically the most disciplined in pricing, has started rolling out aggressive loyalty programs to hold onto its customer base. They see what's happening. They know that if Ram and Jeep get traction with these 50% off deals, customers will begin demanding the same everywhere else. But here's the catch. Most automakers don't have the financial cushion to survive a race to the bottom. Stellantis might be able to absorb short-term losses with help from its international portfolio and deep reserves, but companies with tighter margins or heavier reliance on financing, like Nissan or even some luxury brands, could find themselves in dangerous territory. Once your vehicles are seen as waiting to be discounted, your entire pricing model becomes unsustainable, and consumers are waking up fast. The old rules are gone. The days of paying MSRP, or even close to it, are rapidly fading. Buyers now know that if they wait long enough, prices will crash. It's creating a culture of hesitation, of suspicion, of strategic delay. Dealerships are feeling it. They're watching as foot traffic increases, but close rates plummet. Customers come in, test drive, then leave and wait for the next discount cycle. It's a broken buying process, and no one's figured out how to fix it yet. Meanwhile, the financial institutions that power this entire ecosystem, banks, credit unions, leasing firms, are in defense mode. They're tightening approval criteria. They're adjusting residual values downward. They're pulling back on subprime lending. Why? Because when vehicles lose value this quickly, the risk profile explodes. A bank doesn't want to be holding the loan on a $60,000 Ram that's suddenly worth $35,000 after 1 year. That's how defaults and repo rates spike, and how financial contagion spreads from autos to broader credit markets.